China's manufacturing sector shrunk by its biggest margin in the first 3 weeks of August since the financial crisis of 2009, according to the latest PMI figures. But it's not only China that's slowing. Flagging growth in the world's second largest economy is having ripple effects all over the world, including among a new grouping of the so-called Fragile Five. Joining me to discuss this is Steve Johnson, the Deputy Editor of EM². Steve, welcome. Can you bring us up to date on what's happening with the so-called new Fragile Five?
Sure, yeah. The original Fragile Five were named in 2013. They were the countries worst affected by the infamous taper tantrum in that year. They were Indonesia, India, Brazil, South Africa and Turkey. Since then, JP Morgan have crunched the numbers to try and determine which countries are being worst affected and are likely to be worst affected in the current sell-off from emerging markets. They conclude that three of those original Fragile Five are still amongst the most fragile. They're South Africa, Turkey and Indonesia. But India and Brazil, in their calculations, are now a certain amount safer anyway. Instead, they look at Colombia and Mexico as being quite vulnerable. As we can see from our chart, all those five countries have seen their currencies depreciate against the dollar by between 15 and 40% since the middle of 2014, which is when the oil price peaked at $115 a barrel and has obviously since more than halved. The Colombian peso particularly badly affected there. Their view is that for the newcomers, Colombia has a problem because its oil exports are very, very important for the country, particularly for government revenues, and it has a large current account deficit that has to be funded by capital inflows from foreign investors. All those Fragile Five countries are very reliant on hot money from foreign investors.
And it's interesting also when we look at the new Fragile Five that many of them are susceptible or vulnerable to a waning in the demand from China. And as we know, China is a big factor. In fact, a lot of the emerging market malaise could be said to be made in China. Particularly, I think, of concern is the way China's investment spending growth is really falling in infrastructure, in property, in many other areas. And this is having an impact on certain parts of the world. Latin America is well known. But what we're beginning to notice more and more now is the impact that this is having on Africa. And if we look at the chart here, we've got the blue line shows imports from Africa to China. And as you can see, they really have fallen off a cliff in the last few months. In fact, this piece of research from Fathom China shows a 40% decrease in China's imports from the African continent in July compared to the same month a year ago. So how is this playing out in terms of pressure that this is exerting on African currencies?
You're right, James. I think the wave of selling we've seen so far from emerging market assets has been concentrated perhaps a little bit more in the more liquid assets, not generally including Africa apart from South Africa. But people are looking at the rest of Africa a little bit more now. Certainly there's some concern about the Nigerian naira. The Nigerian central bank has essentially pegged the currency against the dollar since February at around about
a chart, haven't we?
Yeah, we can see here it's been pegged at it's around about 200 naira to the dollar. A lot of people think that peg cannot last. They see it falling to 240 or somewhere around that level in the next few months. Nigeria clearly is a major oil exporter, is badly hit by the fall in demand from China and elsewhere.
And what about the other two, the Kenyan shilling and the South African rand?
Certainly, there is pressure more broadly on African commodity exporters, not just oil exporters. Clearly, South Africa, a large commodity exporter, with a number of domestic problems as well. Certainly, there's a general feeling that the rand is likely to be to weaken against the dollar in the coming months. Another country people are looking at is Angola, the kwanza there.
So it seems really that when it comes to Africa's vulnerability to this emerging market slowdown, we do have further to run.
Absolutely.
Thank you very much, Steve.